Welcome to Prescribing Prosperity with your hosts, John and Alex Soutsos from MedWealth Financial Services, operating through IPC Securities Corporation. In this podcast, we provide unique insights into wealth management, the psychology of financial decisions, and help listeners place the capital markets into perspective. Our aim is to help physicians, business owners, and other medical professionals to live their dream. Life is to live and enjoy, so we'll also cover health and lifestyle-related topics such as food, dining, travel, and unique experiences. Learn how global trends shape our investment strategy as we help you assemble your roadmap to prosperity.
Hello, and welcome to the Prescribing Prosperity podcast with your hosts, John and Alex Soutsos. Gentlemen, good to be with you again.
Hi, Bill. Great to see you again, Bill.
Hey, Alex. For those of you following along at home, this is part of a series that John and Alex have started talking about financial planning for major life events. In the first two parts of the series, the guys talked about some major milestones like buying or whether you should buy or lease a car, getting married, saving for a house. And it was on real estate that we left that last episode off. So today we're going to continue the discussion and look at purchasing a house. And to help us do that is their friend and colleague, Matthew Pickering. Matthew is the mortgage development manager at National Bank. And as part of the advisor banking services team, he works with advisors like John and Alex to provide their clients with preferred banking solutions, including mortgage origination, business lending, and other financial tools. Matt, welcome to the conversation. Nice to have you on board.
Thanks so much, Bill. Happy to be here today.
That's good. I'm looking forward to listening to what you have to say. And with that, I'm going to turn this over to John and Alex. Take it away, guys.
Thank you very much, Bill. As you mentioned, Matt specializes in providing our clients with various financing tools. And so we thought this would be a great opportunity to bring Matt on and join the podcast. We've been talking about having him on for a while. And so this is just the perfect opportunity because his area of expertise dovetails nicely into our discussions right now. So I think this would probably be a great chance for you, Matt, to tell us a little bit about why you and why National Bank.
That's awesome. No, thanks so much, John and Alex, for having me today. It's been great working with you guys so far. It's been about a year or two together through Advisor Banking Services. So, brief background on myself. So, Matthew Pickering at National Bank. I've been with National Bank about 5 years now. What I like about that is it's been a long 5 years, as you guys know too, right? We've seen a lot of change with not just rates, but market behaviors, purchasing behaviors. I'm a big pattern recognition person, so it's cool to see how real estate investors are shifting, how high net worth individuals are shifting, right? What are they doing? And no, it's been great. So as I believe Bill mentioned, I'm part of the advisor banking services team. So I'm a bit of a hybrid role. So part of that is working with great advisors like John and Alex here. What that really means is there's a little bit more offerings we can do than a regular branch walk-in client. That could include having a dedicated onboarding specialist, preferred offers, and just an overall a little bit smoother experience. That being said, a branch customer is obviously going to get the best service as well too. But I find we have a little bit of an edge working with advisors, and there's always when I work with a referral from an advisor, it's not just helping that client's building up on a relationship, right? So how can I continue building something that's great to make it even greater? So really happy to be here today, provide some expertise and help where I can.
Absolutely.
Matt, would it be safe to say that the degree of personal service working with you through us is greater than it would be otherwise for people who are just dealing directly through the branch level?
Yeah, absolutely. Right. So there's a lot of benefits working together as a group. Is one, we'll have a lot of common, a common source of what we need to end up with. Right. So we have a common goal of what we're looking to do. So there's even a lot of smooth transitions with you guys being able to provide us documentation. So we're going to work with you directly on some of those items. But it's working together at that end goal of what are we really trying to do here, right? Are we taking out a bit more mortgage from maybe investment opportunities? Is there going to be are we looking to do a refinance because we're going to transition to a new house, right? So it's kind of working as a team to provide that client with that smooth experience. And, it's always great having another perspective, and the client, ultimately just has to agree to what they want to do. But we're going to provide the backbone of the decisions.
Yeah, I think that's great feedback, Matt, because a lot of times when the bank is in a position where they're trying to vet a client, for lack of a better term, it's obviously a challenging process because they don't know the client very well, and so it's you have two strangers who are trying to determine if there's a safe environment for them to conduct business. And that's there's a cost and a challenge associated with that. Not an insurmountable cost or challenge, but it is a challenge that happens. I know personally, when I went through my mortgage approval process when we were buying our first home, it was difficult for some of the financing. There are the different lenders that we were dealing with to try and understand how my wife's income work, because she's a teacher, but at the time she was not a permanent teacher. She was a what's called an occasional teacher, and she, doing either supply teaching or long-term occasional postings, and they didn't fully comprehend the nature of her cash flows, and so that became a challenge when it came to borrowing. But when you have an existing relationship like us, where we're able to do a lot of the legwork and the groundwork to vet the client to make sure they're a high quality candidate for the bank, it takes a little bit of the burden off the bank's plate. So then they're able to provide better service and potentially better rates for the client, because they have that level of comfort knowing that we have also cleared them in a way. So it's definitely an advantageous position for prospective clients and for existing clients. But let's start with the
Yeah, and
mortgage
even for
approval.
context, just to add to that, so even
Yeah.
when every mortgage application we index all our information, but we add notes to everything, right? So
Right.
a lot of the referrals will be like, this is coming from John and Alex Soutsos, who's our referral partner through ABS. We're building a relationship, we're building a plan with these customers. So it's us able to add a little bit more fluff to the notes to say,
Mhm.
to your case, on paper, if we're indexing, someone like your wife's income, to your average might not make sense, or there's no base because it's contract. But
Mhm.
we're able to say, hey, let's look at the big picture of what we're doing here and come up with an overall way to get this done. And that's where I'd say most of applications today need an exception. Higher qualifying rates are around right now, and what are our areas on the application to push for an exception? Because I would say 90% of my files are getting approved with exceptions. What are we kind of doing to get that done? And again, relying on you guys and your expertise and relationships is definitely one way to get that done.
Yeah, that's a great point, and thank you for providing that additional context, Matt. So let's start with the mortgage approval process, because you just brought it up there, and we talked about it briefly there. What are some of the factors that come into play when you're looking to get a client approved for a mortgage?
Yeah, no, absolutely. So qualification process is really based off the qualifying rate. What the qualifying rate is, the rate you're taking plus 2%, or it's 5.25. We're going to use whatever the highest case is. So back in COVID days when rates were 2%, we're going to qualify everyone at 5.25. Now that we're seeing rates higher, we're going to be taking your rate and adding 2% as a qualification rate. So what that means is today a good fixed rate at 3-year fix is around 5%, where a 1-year fix is closer to 7%. So does that mean there's a different qualification rate? There is. So the ratios are going to be completely different based off of your rate right now. This is also why we're seeing a lot of people maybe decide on fix, because they're qualifying more compared to a higher variable rate. So there's a lot of factors there. In like what I would suggest is you shouldn't take the rate that gives you the best qualification. An experienced mortgage specialist like myself should be able to get you the same approval despite the rate, even though your
Hmm.
qualification rates are different. It's like, okay, we're not going to pigeonhole this customer to take a 3-year fix because the ratios are good when they want to go variable, or they want to take that 1-year fix. So that's where we kind of have to have that expertise to get it done, even though the rates might be, the qualification might be higher on certain products, but getting it, looking at that way. But ultimately, also with a qualification, there's a few other elements other than just qualification rate. So what is the amortization? Are we going to be putting over 25 years, 10 years, 30 years, right? Those are all factors. We're going to, of course, look at income. Income is pretty much, the backbone of your qualification, but there's a lot of wiggle room you have with income. So what's the story with income? So, right. So most of the time there's a bit of a story. If you're consistent year over year at the same company, been there for 10 years, it's pretty simple. If you're just going to use a
Hmm.
2-year average, or whatever that future income could be. But let's say there's someone that's just went from self-employed to incorporated, or someone's changing their they change their companies. That's where we have to provide expertise, is kind of take a look at what the previous year shows, as well as what we're going to be looking in the future. And it has to make sense. There's always a story to tell, and that's my job to kind of tell it, and having the bank recognize it. And with my role, how I look at it is my job is to get to know the customer as much as well as possible. That's I want to make something happen with the customer, especially a referral coming to you guys. It's I want to get this done to help you guys, make our relationship stronger, have something there. It's going to be building your relationship with the customer as you refer them to myself. So I'm pot committed on getting this done. So it's having that expertise and that drive to get files done at in a compliant way. So again, I'm helping the client figure out what's the best way to get the application approved while keeping everything compliant to my bank standards, right? So I'm a bank employee, so everything I do will close at National Bank. So I'm not a mortgage broker or anything like that. I'm a bank employee. So everything I will do will close at National Bank, but I know our products inside or out. I know our processes inside out. I built up a lot of experience there to say, okay, this is how we kind of have to go about it. And these are kind of the approvals we're looking at.
Yeah, absolutely. I think that's a great way to frame it. You're building a story because, like you said, not everybody's story or not everybody's employment is going to necessarily be in the same vein. Like you gave the example of somebody's been employed at a company for 10 years. That's a very easy straight line to say, okay, well, this is what their average earnings have been over the last 10 years. I think we can make a pretty good assumption that it's going to, barring something catastrophic, it's going to be something in this neighborhood going forward. When it's somebody who's self-employed, there's a little bit more gray area that has to come into play. And that's where it's important to work with somebody like yourself who can actually go to bat and work hard to understand the person's individual situation and communicate and be an advocate on behalf of that individual in order to help get them the best rate possible. Because a lot of different lending institutions, they're not always motivated to do that. As a financial lender, you are risk averse. Generally speaking, you want to take the lowest amount of risk in order to make sure that your margin is adequately covered, because they don't want to take a chance that somebody defaults on their mortgage and that they're left holding a property. The bank's not in the business of owning real estate. They want to take their money and they want to redeploy it in other areas. So having somebody who can actually bridge that gap and help alleviate some of the risk considerations on behalf of the bank is very important. So. Let's talk about pre-approvals right now. What's the process for a pre-approval? First of all, what is it? I think for a lot of people, they hear the term, they don't necessarily know. Let's start with that.
Yeah, no, exactly. Pre-approval is going through an application to say, okay, based off of indexed income, I qualify for X mortgage, right? So this is where we index everything, put it in the system, put the numbers in. Because we don't know the subject property, let's say, for example, you want to go buy your next house. We don't know what that house is, but you're looking for a pre-approval. So the system will recognize generic property details. In my opinion, they'll be inflated to be a little bit less risk for the bank.
Mm-hmm.
So typically you'll get a little bit more than your generic pre-approval amount. But a pre-approval will be, okay, I put all your information in the system, it spits out a number, here's your certificate, you're approved for X amount of mortgage. Where the challenge with pre-approvals is pre-approvals, like just a simple pre-approval, is great for people with that flatline income we discussed.
Mm-hmm.
Let's say you're self-employed, and one of my favorite type of customers is someone who's self-employed, because that's a huge part of the storytelling when I'm submitting a file. So most of the people aren't going to be paying themselves max amount, right? Why would you? You're just going to get taxed on it. So if you're an incorporated business owners, we're able to consider your business financials. We're going to go through them, see what we have there, see an additional net income. We're able to add that net income to your application to say you qualify. So going back to the pre-approval process, the benefit of doing that, the biggest thing we were doing back in a few years ago was locking in rates, right? So we can hold a rate for 3 months or 6 months. Your 3-month hold will be a better rate than a 6-month hold, just because there's more certainty of it closing. That being said, if we're doing 6 months, we can of course update your application, your rates during that application as we get closer to, as we move along. But the pre-approval is going to kind of give you a certainty of what you qualify for. What I like to do on top of just a generic pre-approval is have my calculators all indexed, ready to go of, okay, here's the income I'm using. Is there any additional income that I'll have to use on an exceptional basis? So is that going to be your net income? Or maybe, let's say, for example, you just started a new job. To be compliant to your income is just your base salary. But if on your letter of employment states your 15% bonus, we know that's where there's a little bit of wiggle room. with my calculator, I can kind of index, and I've gone to know certain cities throughout the GTA, even Ontario at this point, of saying, okay, this is your kind of property tax you're going to be looking at. I always like to know, hey, are you going to be buying a condo? Because if you have if you're going to be buying a condo with $800 condo fees versus a semi-detached with nothing, there's a very big difference in your qualification. So it's like, let's do something offline as well to kind of run scenarios of what kind of different properties are. I'll also have customers saying, hey, I'm kind of undecided. I might want to buy a condo or I might want to buy a duplex. Well, those are very different qualifications. So let's run through both scenarios. And that's where I'll send, I can get a pre-approval, get that in the system, but I'll also send an email saying, hey, based off of, you want to buy a duplex and I'm using generic property values of, rental income of X and, property taxes of Y. So here's your pre-approval range. So you're good for a mortgage of 750 to 800. It's going to be closer to 800 if there's lesser property taxes. And so give them a bit of a range. And then as we go through the process, and they're starting to put in offers. It's like, okay, go ahead, share me that listing, and I'll be able to give you that exact mortgage amount that I can get approved. So kind of going through it that way, but having the pre-approval in the system is a great way to hold rates. It's less of a concern in today's world because we're seeing the rates decline. But for example, a lot of realtors won't really want to start working with customers until they have some kind of formal document because, a realtor doesn't want to go show someone a $1 million house if they're only qualifying for 200,000 mortgage.
Yeah.
Right.
Or conversely, making an offer on a $2 million home that they can't afford. And then, the realtor, their reputation suffers damage because they're representing clients who are basically fraudulent buyers. They have no actual capability of owning that home.
Exactly. And that's why your first step to the purchase process should really start with a mortgage specialist. Get an understanding of, where do I stand today, right? It's kind of just like a financial checkup. What do I qualify? What's my range? What are my options? And that's where it's always a great place to start. What I'll also add in too is working at National Bank is a tier 1 bank. So we're a major lender. We're top 6 major bank in Canada. I always like to say we're top 3 of the rates. We're very competitive there. But when you're going through a new construction process, let's say you're looking to buy a new construction condo that's closing in a couple of years, those builders are going to require a formal pre-approval from a tier 1 bank. Those are things I can help with no problem. We get something in the system, we start working on a relationship early. Here's your pre-approval. You satisfy the builder requirements, and on we go, and we continue as we get closer.
Yeah, and that's a great point about doing it early on in the process. I think that, and you mentioned that we actually had a presentation recently where Matt came out and spoke at a real estate event, and I think one of the best things that you said was people need to get started with speaking with a mortgage specialist like yourself sooner rather than later, because the last thing you want is you want to get to the 11th hour of closing on a home and you don't have a mortgage in place. I can speak from experience on that. So we did start early, but as I mentioned, we had some challenges based on my wife's income, and our mortgage approval fell apart at the 11th hour. I believe we were only a couple weeks out on closing on our home, and that was a very stressful time because you're sitting there, you're worried that you're going to lose the home that you found, and it took us a while to find a home that we really liked, and to have that almost fall apart at the last minute can be a very stressful process. And there's more that you can do. I know you mentioned that during the presentation. There's more that you can do when you're given extra time to work on the case. And create better options and maybe find different alternatives for your clients, as opposed to somebody comes to you at the 11th hour and there's only so many opportunities for you to go out and find different options for them. So I think it's an important lesson for people to start early in the process. And you got to think about the mortgage broker or the mortgage specialist like yourself as being part of your home buying team. You're going to have us as your financial advisors who are going to advise you at from the early stages and telling you, okay, here's how many assets you have. Here's where you should be allocating those assets. Are you ready to buy a home? Yes or no, based on your cash flows. Then, you guys should be step 2 in the process. Okay, we need to, now that we feel like we've built up enough of an equity base that we're ready to make this happen, we need to go out and find out definitively how much we can afford. And then, the realtor should be probably step 3 and, adding on that third leg of a stool, if you will, to your team that's going to support you as you go out and try and find your dream home. And then once all those different pieces are in place, then you can actually make an educated decision as to, okay, not only do we like the house on the outside and on the inside, but is this financially the right house for us? And we can make an informed decision going forward.
No, absolutely. And like even I would say today in today's world, what we're starting to see again is competitive offers, meaning you may see a decent house, and it's the more popular ranges, which is a house purchase price of let's say 800,000 to 1.2. Those are the ones that go pretty quick right now. So
Hmm.
those are those are where people are like, I need to get my pre-approvals in place before I put in offers because I may not be able to put a condition on financing. We're
Yeah.
starting to see, suggestions of waiving that condition of financing because there's 10 offers and they're all more or less the same kind of offer. You're going to take the one with the least amount of conditions.
Yeah.
So let's get ahead of it. And my job is like for a purchase process, there's so much to that process, right? So, do I even love this house? Do I have to now start worrying about selling my house? There's a lot of stress that can be involved. My job is to remove that stress on the financing side. Let's
Hmm.
start early. If you're not even, let's say you might want to buy something by end of year, it doesn't hurt to start now because ultimately we're going to be looking at your tax documents, which really aren't going to change, right? So your 2023 T4 is what it is. It's going to be on towards your income calculation for the next 2 years. So we have that already. As we start seeing like the different timings of the years, that's where we can strategize too, where it's like, okay, let's say it's October and you might want to buy in the new year. Okay, well, what are we looking at for the last years of income versus where do you think you're going to end up in this year? I also like to work, like I mentioned, with self-employed people where naturally they're behind on their taxes. That's just a common theme I always see. They give it a little bit more buffer of time from the government, and they're usually going to be on that 24th hour getting that done. So I also work with the customers and their accountants. Say, okay, we have a plan to buy a house of X amount. To qualify, I need to kind of show a bit of income of this amount. So maybe this year you're going to pay a little bit more taxes because we have more usable income on the application. So it's finding
Hmm.
that balance. And again, starting early is always a suggestion because it gives us time to strategize, and that's really important in today's world.
Yeah, absolutely. And actually, a quick sidebar on that, Matt, before I go into my next question on the mortgage approval process is, I assume, and you can correct me if I'm wrong, does the National Bank provide any sort of bridge financing for those people who, they
Yeah.
currently own a property, they are trying to sell it, but sometimes the timing doesn't quite work out between moving their existing property and buying the next property. Do you guys provide anything that can help buffer that or bridge that gap?
Absolutely. So bridge financing is a great tool to have when your closing dates don't align. And it's more
Hmm.
common to have closing dates not aligned because closing a sale and a purchase on the same day can be stressful. You might not get the keys to 5, you might have your stuff in the truck all day. There's a lot going on. So giving yourself a bit of a buffer makes sense. Also, let's say, for example, just based on offers, you couldn't get them to align. It happens. We can go up to bridge financing up to 90 days. So it's a interest only loan that's generated based off of the amount that you need for your down payment. So let's say you're upsizing and you're from the sale of your home, you have 200,000 that you're going to put towards the next home, but you won't have that because your new home's closing before your old home settles. So what we do is provide that bridge financing for that amount to provide that coverage for while you own both properties. What we can do in bridge financing, it's a variable rate, so it's prime plus 3%. So it's a higher rate. It's an
Hmm.
interest only loan. It's not secured against anything. There's ways we can strategize if this is your plan. Like for example, as we start to see people maybe getting closer to retirement and they want to downsize, they may already have quite a bit of equity in their existing property. So there's a lot of times what we do is, I want to buy something in the next 6 months, Matt. Okay, that's perfect. Let's add a home equity line of credit to your current place. This is going to be a better rate. We're going to have a bunch of equity available at a line of credit interest rate.
Yeah.
Again, with an ABS offer or wealth management offer, it's going to be a better rate than a standard home equity line of credit rate. So we have this line of credit already there, and that's going to be a solution to help with the bridge financing. Maybe you want to run with both properties for a little bit more than 3 months. Maybe you want to,
Mm-hmm.
get in and then sell. Maybe you have to do a bit of work before you sell, or whatever the case is. So between a combination of bridge loans and home equity line of credits is the best way to have that transition. And again, it's starting early to kind of see, I don't need the line of credit today, but if I'm going to do this transition, let's just add it early to my existing property. So that way, when I do move, I have funds available to use, and that'll just be all paid out at closing when that property settles.
Yeah, that's a great point, and thanks
Matt,
for providing the context.
Matt, on the subject of the home equity line of credit, many of my clients are older individuals into retirement, and I've consistently over the course of time suggested that if their home is paid off or nearly paid off, that they register a home equity line of credit, even if they don't use it, just from the standpoint of having the ability to see if anyone's attempting to steal their identity and take away their real estate property. I know this might sound strange, but this is something that's been going on for the last 15, 20 years. And what are your thoughts on that?
No, this is something I tell people all the time too. So whenever I hear someone has a free and clear property, it's like, congrats, like that's awesome. Congrats, you have no mortgage. That's a great achievement. But now, is there anything registered on it? Because if there's nothing's registered on it, what's coming up from a fraudster saying, "Hey, this is my property. Here's a fake property tax bill." The bank's not going to go knock on the door and say, "Hey, do you live here?" So there's nothing secured against it. And now someone has the possibility to add financing on that property without you knowing. Where if you have something registered, so let's say you have a home equity line of credit, that's going to be registered with the bank. So the National Bank will have their name on the deed with your name and the financing amount that we put on it. So when that case where the fraudster is going to try to put something on it, when the lawyer gets in the lawyer's hands, they're going to say, "Hey, what's this? There's already a lien on this property, right? So what's going on?" And that's how it stops, right? So if there's no lien on it, there's full advantage. And when I say lien, a lien is just something registered at the bank. So that can be a mortgage loan or it can be a home equity line of credit. Both are secured financing products that are put against the home and secured. So that's kind of a great solution to have for not have not have fraudsters being able to put something on it.
So that means just having the line of credit doesn't necessarily mean you have to be drawing upon it, as long as you have something registered and on the books that is sufficient to provide you with protection, correct?
Correct. Yeah, exactly. And the line of credits, you pay interest once there's a balance, right?
Yeah.
So, and a lot of times too, people, don't need funds until they need them, right? So adding a home equity line of credit is, a comfortable 3-week, 4-week application. It's going to take about 3-4 weeks. We can get it done in 2 weeks if you really have to start pushing and shoving, but it doesn't hurt. Like, let's say we don't have anything on it and then something comes up. Maybe we need to borrow for RSP loans, or maybe we have to, I don't know, whatever. We need to gift a down payment for your son's purchase. Having it just there never hurts, right? It doesn't hurt your credit score anyway if you have it available. If anything, it improves it because it shows you can demonstrate you can hold credit without actually racking it up and blowing it all. So to me, there's a lot of advantages of having home equity line of credit on a free and clear home, and those are things we help people with every day.
The other consideration for that is once people are retired, the ability to qualify for loans becomes more difficult. So I recommend to people that they should, before they retire, get a home equity line of credit, even if they don't need the money, just because at some point in the future, for all the reasons you mentioned, Matt, they might need some funds out of the blue. The line of credit is already in place. They can access it. They're not going to go hat in hand to the bank saying, "I need a loan." And the bank's going to say, "Well, where's your income?" "Well, I have my RIF income and my pension income." And then it becomes a more difficult conversation.
I love that advice, and that's so well said, because that's things I like to advise when I start hearing people saying, "Hey, I might be going into retirement in the next 4 years." I was like, "Okay, well, let's take a look at what we qualify with your current income and maybe what you qualify once we retire and take minimum income." And it's really no different from the concept of someone saying, "Hey, you know what? I want to maybe go self-employed in 2 years." Okay, well, let's take a look at what you qualify with your current salary. When you're going self-employed or incorporating, you might not be drawing much of an income off the get-go. So regardless of whatever that major life change is, take a look at what financing looks like before you make that change, whether it be retirement, career change, and then let's see what it would look like after. And if you're safe after, that's okay. But again, there's no real negative of having something done early, in my opinion.
Yeah,
that's great. Matt, on the subject of fixed versus variable interest rates for mortgages, for the last, let's say from the early 1980s up until the last 3 years, it's been really a no-brainer. Everyone getting a variable rate mortgage was the way to go. Interest rates had been coming down steadily, but all of a sudden we have a new world with COVID and shutdowns and inflation, and now we don't have interest rates that are steadily coming down. We have a situation that actually might be a lot more difficult in that we're going to have some mortgage resets in the coming 12 to 24 months at significantly higher rates than people were paying for the preceding 4 to 5 years. So two things. One, what are you seeing in terms of people's decision making, or even what's your advice to people on fixed versus variable rate mortgage? And the second part of my question, do you see a problem in the next 12 to 24 months with resets and how that is going to impact banks?
Yeah, no, great question. So again, I can't, I'll never be able to crystal ball where the rate's going, but like I said earlier, my big part of why I like my job is pattern recognition, right? So what we've seen over the last couple of years has been, there's a lot of outliers, right? So right now, the common theme of what I would say people are taking right now is a 3-year fixed rate. Why the 3-year fix, you might ask? The 1-year and the 2-year fixed rates are significantly higher. So for example, 2-year fix is at least 1.1% higher than a 3-year. The 1-year fix really only makes sense for a customer right now who wants to sell in a year, has a reason to need to get out of the mortgage in a year. Those are the main causes. The 4-year and the 5-year fix are relatively similar to a 3-year fix. So because of the similar rates, it's better to take a shorter term because these are historically high rates. In theory, you should have a better rate in 3 years. So take a 3-year fix, you'll be able to convert it. Going to your comment on variable, I agree. I'm a variable mortgage holder myself. I see a lot of benefits with variable. My challenges I've had with variable these last 2 years is the spreads. So prime's high. We know that prime's, we just had our first decrease this month, which is exciting. It was a 0.25 decrease, which was kind of expected to happen June or July. But the spreads on variable haven't been great to start off. So what I mean by that is, to me, a historically good variable spread is prime minus 0.9, maybe prime minus 1%. That's kind of your base level. Back in COVID days, I was doing prime minus 1.3s, 1.25s. Those were great spreads. Today, like starting off as like maybe not the best rate is like prime minus 0.4, 0.5. We're starting to see that improve. Like I'd say last year, we're like prime minus 0.4 for a primary, which was like not a good spread at all. And the rate's already higher, right? So your variable rate's going to be higher than the fixed rates right now. So to me, I think we're going to start seeing the spreads on prime get better for variable offers. So because of that and because of the difference, so right now, I know even though we just had a 0.25 decrease on variable, I would say the difference between, let's say, a 3-year fix around 5% versus a variable at, let's say, 6.4, you're going to be about 1.3, around that mark difference. So what what the forecast is for this next year and a half is, if we look at where rates should be. So let's look at where rates are today and where they should be. So rates today are the 1-year fix that is the highest, the 5-year fix is the lowest. That's actually backwards. It should be inverted. To the bank, your 1-year fixed rate should be the lowest rate. There's less risk to the bank, right? You're less likely to default on a mortgage in 1 year versus 5 years. So your 1-year rate should be the best year rate. So I think over the next, let's say 2 years, we're going to start seeing that teeter back. So we're going to start seeing the 1-year fix and the 5-year fix level out and then eventually go back to where they were. Same with variable versus fixed in general. Variable in theory on over the 20-year average should be lower than your fixed rate. Right now it's higher than fixed rates. So what we're kind of seeing in the forecast is variable is going to come down at a faster rate than fixed. So for example, just this month alone, we had variable come down 0.25% and we had fixed come down 0.1%. So there's going to be, slow decreases of fixes, but faster decreases than to variable compared to fixed. I personally do think variable is going to be a slow decrease. It's going to be a slow, consistent, decreases of 0.25. There's 8 Bank of Canada announcements every calendar year. Kind of what makes sense to me and what had been forecasted is, a rate decrease and then a pause and then a rate decrease and then a pause. So it's going to be a stagnated decrease of 0.25 every decrease, unless something significant happens. Back in COVID, we started seeing, very fast decreases. So if everything kind of stays where it should and everything starts getting back to normal, we'll start seeing that trend of those decreases. Our next announcement's end of July. So that's the next, is it going to go down? As a variable mortgage holder myself, I'm gonna predict that it doesn't, but it will in September. If it does go down in July, I'm happy. If it doesn't, hey, we're being conservative with our thinking with variable. Where we're seeing fixed rates is our forecast last year, were fixed rates at the end of 2024 or where they are now. So we had a pretty sharp decrease in fixed rates from November till, let's say, March. So November, we were like, to do a bit of work before you sell or whatever the case is. So between a combination of bridge loans and home equity line of credits is the best way to have that transition. And again, it's starting early to kind of see, I don't need the line of credit today, but if I'm going to do this transition, let's just add it early to my existing property. So that way, when I do move, I have funds available to use, and that'll just be all paid out at closing when that property settles.
Yeah, that's a great point, and thanks
Matt,
for providing the context.
Matt, on the subject of the home equity line of credit, many of my clients are older individuals into retirement, and I've consistently over the course of time suggested that if their home is paid off or nearly paid off, that they register a home equity line of credit, even if they don't use it, just from the standpoint of having the ability to see if anyone's attempting to steal their identity and take away their real estate property. I know this might sound strange, but this is something that's been going on for the last 15, 20 years. And what are your thoughts on that?
No, this is something I tell people all the time too. So whenever I hear someone has a free and clear property, it's like, congrats, like that's awesome. Congrats, you have no mortgage. That's a great achievement. But now, is there anything registered on it? Because if there's nothing's registered on it, what's coming up from a fraudster saying, "Hey, this is my property. Here's a fake property tax bill." The bank's not going to go knock on the door and say, "Hey, do you live here?" So there's nothing secured against it. And now someone has the possibility to add financing on that property without you knowing. Or if you have something registered, so let's say you have a home equity line of credit, that's going to be registered with the bank. So the National Bank will have their name on the deed with your name and the financing amount that we put on it. So when that case where the fraudster is going to try to put something on it, when the lawyer gets in the lawyer's hands, they're going to say, "Hey, what's this? There's already a lien on this property, right? So what's going on?" And that's how it stops, right? So if there's no lien on it, there's full advantage. And when I say lien, a lien is just something registered at the bank. So that can be a mortgage loan or it can be a home equity line of credit. Both are secured financing products that are put against the home and secured. So that's kind of a great solution to have not have fraudsters being able to put something on it.
So that means just having the line of credit doesn't necessarily mean you have to be drawing upon it, as long as you have something registered and on the books that is sufficient to provide you with protection, correct?
Correct. Yeah, exactly. And the line of credits, you pay interest once there's a balance, right? So, and a lot of times too, people, don't need funds until they need them, right? So adding a home equity line of credit is comfortable 3-week, 4-week application. It's going to take about 3-4 weeks. We can get it done in 2 weeks if we really have to start pushing and shoving, but it doesn't hurt. Like, let's say we don't have anything on it and then something comes up. Maybe we need to borrow for RSP loans, or maybe we have to, I don't know, whatever. We need to gift a down payment for your son's purchase. Having it just there never hurts, right? It doesn't hurt your credit score anyway if you have it available. If anything, it improves it because it shows you can demonstrate you can hold credit without actually racking it up and blowing it all. So to me, there's a lot of advantages of having home equity line of credit on a free and clear home, and those are things we help people with every day.
The other consideration for that is once people are retired, the ability to qualify for loans becomes more difficult. So I recommend to people that they should, before they retire, get a home equity line of credit, even if they don't need the money, just because at some point in the future, for all the reasons you mentioned, Matt, they might need some funds out of the blue. The line of credit's already in place. They can access it. They're not going to go hat in hand to the bank saying, "I need a loan." And the bank's going to say, "Well, where's your income?" "Well, I have my RIF income and my pension income." And then it becomes a more difficult conversation.
I love that advice, and that's so well said, because that's things I like to advise when I start hearing people saying, "Hey, I might be going into retirement in the next 4 years." I was like, "Okay, well, let's take a look at what we qualify with your current income and maybe what you qualify once we retire and take minimum income." And it's really no different from the concept of someone saying, "Hey, you know what? I want to maybe go self-employed in 2 years." Okay, well, let's take a look at what you qualify with your current salary. When you're going self-employed or incorporating, you might not be drawing much of an income off the get-go. So regardless of whatever that major life change is, take a look at what financing looks like before you make that change, whether it be retirement, career change, and then let's see what it would look like after. And if you're safe after, that's okay. But again, there's no real negative of having something done early, in my opinion.
That's great. Matt, on the subject of fixed versus variable interest rates for mortgages, for the last, let's say from the early 1980s up until the last 3